Hello, everyone, and welcome to the High Return Real Estate Show. This is your host, Jack Gibson, and I am going solo today. Shecky is actually on a 9-week extended trip to Texas, beautiful city of Austin, to visit his dear mother. So I'm going to run the show today, and we have a very special guest that has over 19 years of experience in real estate cash flow investing. So stay tuned. We got an awesome episode for you guys today.
Welcome to the High Return Real Estate Show, the podcast for heavy hitters. 2 men, 1 mission. It's time to build your empire.
All right, everybody. So buckle up. Incredible show, incredible guest. I want to introduce you to Kevin Bupp. He's a Florida-based real estate investor. He also has a top iTunes podcast, and he's a serial entrepreneur with over $150 million of real estate transactions under his belt. It's pretty serious, guys. His extensive investment experience spans apartment buildings, single-family homes, office buildings, raw land, condos, and now by far his most profitable and favorite, mobile home parks. Kevin, what haven't you done here in real estate? I can't think of anything else that's really left.
Yeah. There's still a few things in there. I think we've never done any ground up developments or anything like that. So we still have a lot to go, I think. But Jack, thank you for having me here. Very much looking forward to being a guest here on the show.
Oh, absolutely. Glad to have you. Thanks for joining us. And we're definitely looking to diving into specifically the mobile home park. I don't believe after I think we're almost 60 episodes now that we've actually talked about or had a guest that specializes in this asset class. So very excited to learn myself. So why don't we start with the easy question, right? The warm-up question is tell us a little bit about yourself, your background, and anything you want to share is fair game.
Yeah, absolutely. And again, thank you for having me here. And I've been a full-time investor my entire adult life. I'm 40 years old now, and got introduced to real estate back when I was 19. I was still going to community college, not really knowing what I wanted to do with my life, and just by accident kind of stumbled into real estate from a girl that I was dating at the time. Her mother was dating a guy.
That's got to be a really good story. So
no, it's not too crazy, but her mom was dating this guy that was a local real estate investor, and would see him over at their house all the time and just befriended him. He was, I guess he's probably about 25 years older than I don't know his exact age. I don't think I've ever asked him, but I've known him for 20 plus years. In any event, he was a local investor in Pennsylvania where I grew up, owned a bunch of single family rentals and smaller multifamily stuff. And, I'm not sure what it was. I don't think I've ever asked him, why me, but he invited me after only knowing him a few weeks. And I didn't really show interest in his business because I didn't understand it. It wasn't something that I had a prior interest in, to where I had read some books and, I was intrigued by it, to where I was, trying to uncover or pull back the curtains from him. But,
Sure.
I think maybe he saw a 19-year-old with no really direction other than going to school for the point of just going to school, right?
I would argue that he saw some desire in you.
Yeah, I maybe I need to ask him, I guess. And anyway, he invited me to a 3-day boot camp down in Philadelphia that he had essentially already paid for. His partner couldn't go with him, and it was $3,000. And so in my mind, I'm thinking, I would never spend that much. I barely had that much in my bank account, let alone, spending that to go get trained for 3 days and something I don't even know about. So in my mind, I'm like, if he's willing to pay for it, absolutely. Like, what's the worst that could happen here? And so I went to this 3-day boot camp with him that basically was teaching how to invest in residential homes, basically fix and flip or fix and keep as rentals, which is what his business model was. He was a cash flow investor. I mean, he would very rarely ever sell anything. Most of the time he kept it long-term. In any event, I went to this 3D boot camp, and I met a lot of people. There's probably 150 people there. I met a lot of people that were making a lot of money, and I didn't really think they were any smarter than I. They knew more than I did about real estate at the time, but it brought some reality to me that, this isn't rocket science, and maybe this is something I can grab a hold of. And I was intrigued at that point by, like a lot of folks are in their 19, by material things. I wasn't making a lot. I was tending bar while I was in community college, and I wanted something bigger. I just didn't know how to get it, and this seemed like the pathway to possibly getting there. And I essentially went to David after that event. I said, I still don't fully understand what's going on here. But I get that there's a huge opportunity here in front of me. I'm not sure how to reach out and grab it. How can I help you? How can I basically bring some value to your business so that I can be around you more and learn what it is you're doing? And so I essentially, for more than a year, I think about 14 months total, I helped David in every way possible. So in between tending bar in the evenings and going to school during the day, every waking hour that was a business hour, I was either out in the field with David at one of his rentals. I was in his office, helping him, renew leases, draft up paperwork, go meet contractors, meet realtors, to go see new properties that he was looking at buying. I mean, whatever he needed help with. It was just running errands, literally. Go to the store for me. Sure, I'll do that. Yeah, I became his errand boy, and I wanted to be around him so I could just be fully engulfed by the information that he had at hand that was stored in his brain. And that's what I did. And so I did that for about 14 months. And until I had enough money in my bank account from savings of attending bar. And I had enough, what I felt is to be knowledge at that time to go out and do it myself. Go buy one of these properties that he was buying and hire a crew, renovate it. And at that point I had to really more so focus on flipping homes. Because I need the money back. That's all I had. I had like $7,000 to my name. I need to be able to.
Sorry to interrupt. Was that a volunteer type position, the 14 months with him? Or?
Yeah, I didn't get paid. No,
thinking about that, isn't that like so many people are not willing to do that? But think about like the level of education that you got in those 14 months.
Oh, it's worth so much.
Harvard degree. Right? Harvard degree.
I don't know where I'd be at today, honestly, Jack. I probably would be in a different field. I probably would have gone to school, and gotten a job, some boring job. And maybe 20 years later, I would have realized that there's something bigger in life. But I don't know if I would have ever had that epiphany that I had if it wasn't for David. So in any event, I started buying really low-end rundown homes in the city where I grew up. And again, had to flip most of them in the beginning. Like literally would buy 3, flip 2, keep 1 type thing. And
was that profitable?
Yeah, absolutely. So I had to stack cash because I literally had $7,000 when I bought that first house, and I used every single penny of it to buy that first property. I relied on David, his resources. He made an introduction to a private money lender that he had been using. I got to know this guy over the year of working with David, and so he had trust in me. But I put every penny of that bartending money into buying that first property. I didn't partner with David. I didn't, I did it all on my own. He acted as a sounding board and kind of helped out when I asked it, but he kind of let me do my own thing. And start with 1, start with 2, just kept buying. And
what did you make on your first deal? $7,000 investment.
Yeah, I think after it was all said and done, and I didn't really, in my mind, I wanted to be like him from the get-go, which he was a cash flow investor. And so I didn't go into it with the idea that I was going to have to buy it, fix it, and then flip it right away. And on my mind, I was like, well, I'm just going to buy it and it's going to cash flow. And it did. But after like 6 months, I'm like, well, this doesn't make sense. I can't buy another one then, And so I think I ended up making like a true profit of like $14,000 on it. So
that's a pretty awesome return off.
Yeah, but there were some holding costs there, going through the, it wasn't a great part of town. That actually the tenant that I had in there had signed a 1-year lease and they bailed out within 5 months. And, so there was some lost cost of that, but it kind of worked out in that they bailed out because I sold it after that to an owner occupant. So it actually kind of worked out that way because I wouldn't have been able to buy another house. I had to use that money to leverage it to buy the next property. So, again, it got to the point to where I was basically buying every 3. I would essentially keep one of those, flip 2, keep 1, flip 2, keep 1, until I got enough money stacked up, and until I also really understood the power of OPM, of other people's money, and getting partners involved and really leveraging that aspect of the business. So. Anyway, I did that for a couple of years. I was 20 when I bought my first property. I moved down to Florida. I needed to get the heck out of the cold weather. So after I finished up school, I knew I was going to leave that place, that dreary, cold place that I never got used to. I still don't like cold weather to date, but moved to Florida when I was 22 with really a vision of bigger things. I wanted to move to a bigger city where there's more opportunity, more progressive. And I came here and hit the ground running, man. And within about 4.5 years, built up a single-family rental portfolio of 122 properties, just shy of 500 apartment doors, and various other types of real estate. Had a very, very large mortgage company as well, and fast forward to 2007, 2008,
So
most of
hold
that
on.
imploded.
Yeah. Oh, okay. Gotcha. So I was going to say,
Yeah.
were you, I mean, that's a huge amount of scaling in a short period of
Yeah.
time. How much of that was OPM versus your own capital that you put in?
I mean, we had a lot of bank debt on properties. I mean, and we would initially go in and buy properties with a private lender, and then we buy them at 65, 70% in the dollar. And these are single family properties for the most part that we were buying back then. And essentially, get 8 properties or 10 properties, and then go get a commercial line. Pull out 70% loan to value on the 10, package of 8 or 10,
Yep.
and then pay back the private lenders. Do it again, do it again, do it again. So we used OPM for the acquisition side, for a majority of the acquisition side, and then would leverage it with bank debt and get the investors paid back.
Yeah. So for our listeners, guys, so essentially, if you think about what he's doing, I mean, he's borrowing cash, right? At this point in his career, he's borrowing cash so he can purchase distressed property, and then at a discount, right? Because cash is king. Anytime you're buying cash, typically you're going to get the best pricing possible. And then, so like you said, 65, 70, even less, maybe on some deals, right? Percent on the dollar. And then they do any rehab that they need to do if it needs it, and they get it performing. And then you go to the bank and you're pulling your cash essentially back out and restructuring it into longer term, lower interest debt.
That's correct.
So cash out. So this is essentially, it's what we recommend, like a lot of our investors do if they're looking to work with us. It's a cash deal with us. And then if they want to refinance it into longer term debt with a bank or whatnot, that they can do that cash out refinance. So I just wanted to kind of make sure all our listeners were clear on your strategy, because it is a simple strategy, but sometimes we tend to overcomplicate things, right?
Sure.
So, yeah. So awesome. Okay. So then you said everything imploded with the 2008, was it? Or 2009?
Yep. Yeah. And it was most of my single family stuff is what really brought us down. It was all here in Southwest Florida, which was kind of one of the main ground zeros where things hit really hard. And there's just lots of spec homes built down here over that period of time for rooftops built for folks that weren't really coming here. The construction trade was drying up and people were moving out. And it was just what happened is we noticed a significant decline in our occupancy in a very challenging time renewing leases on our single family properties. Because what was happening is, and this was kind of concentrated to where we're at. And I know this happened in Nevada, Arizona, certain parts where there was just a lot of rooftops built in a speculative manner.
Sure.
A lot of these, thousands of spec built brand new 322s or 422s, they weren't selling. And so a lot of these builders started essentially renting these things out, converting them to rentals to cover their debt. I mean, they had all these rooftops that they were paying on and they weren't selling them. And so there wasn't a larger population growth coming at that point. And so people were like, well, hey, I can live in this 20-year-old home that I'm paying $1,000 a month for, or I can move in this brand new home never lived in before for not much more. And so we were basically getting poached, is the best way I'd like to put it, by these new homes. And it happened for a period of a couple of years, and we couldn't sustain. I mean, it literally went from, within a period of 12 months, our average on our single family portfolio, our average loan to value across the board was like 66%. So very low leverage rate. It went in 12 months, we were completely upside down in value on our entire portfolio.
Wow.
In addition to that, we lost about 18% of our occupancy. And so we couldn't service the debt. I mean, it literally went from cash flowing to having a, huge amount of equity to no equity, negative equity, and, writing checks every month to make up the debt service. So
that's rough.
Yeah, it wasn't sustainable. And so
how do you handle that, like personally and emotionally, and like, does it wreck your whole persona, or do you try to just keep a great attitude through it? Like, how did that?
Yeah,
what
that's a
happened
good question. I did my best is the best way to put it. Unfortunately, at that point in time, a lot of the banks weren't willing to work with us. It was too new. Like the recession was too new, and a lot of the banks weren't feeling enough pain yet. Yeah. If we could have held on for 3 years, we probably would want to restructure everything, and the banks would have been jumping up and down for joy for us to do that. But that wasn't happening in the first 12 to 16 or 18 months of the recession really taking hold. And so every private loan we had, we absolutely made well on. The banks, we had a couple banks work with us, not many would. And so we tried to hold it together as much as possible. It ultimately had to let everything go. It was really strategic. We wouldn't be able to keep feeding the beast, and we didn't know how long this downturn was going to play out. And ultimately it played out way longer than what anyone realized. Emotionally, it was tough, man. Thankfully I wasn't married at the time. I didn't have kids, and so I didn't have to worry about that part of my life. I just had to worry about me. Although I did meet who is now my wife. I met her literally in 2008, about a month or two before I defaulted on everything, which is crazy that she stuck around.
Right.
So it was a little tough on the confidence level, knowing that, when she met me, I had a lot of things which don't really mean anything, but like in her mind, she had this vision of who I was. And ultimately it went down to being literally completely broke. I mean, I got my personal bank account garnished. They literally took everything. And so it was tough, man. I took about a 3-year hiatus from real estate, and just focused on, the one thing I could control, man, was my health and my fitness. And I know that if I just had a good foundation there, that everything else would work out. If I could just be healthy and feel really good every day about the things I did have, that ultimately everything else would come back around. And so that's what I focused on, man. I literally started a couple other businesses that were non-real estate related. They were health and fitness oriented.
Yeah.
And just stuck with that to keep my brain clear, keep focusing on, tomorrow, like, let's just get past this and let's get through it. And she stuck by my side, and we've got 2 beautiful kids today. And
wow.
And we got back on top, but it took a number of years.
I appreciate you authentically sharing there, because, sometimes I think a lot of people will be more than willing to share, the successes and here's where we're at and today. But most of the time, if you kind of go behind the curtain, so to speak, there was a dark period in time that kind of led to that was very much a testing moment. So, or testing, years. So that's awesome. Like what you're able to do and what you're able to turn that around. So kudos. So yeah. So what's next then? You got back in after, 3-year hiatus and just kind of missed it. Like there's a piece of you that was like, always like, real estate's always,
it was burning,
my jam, so to speak.
Yeah. The fire never really went out. I mean, it definitely diminished to a really small flame.
Yeah,
that was barely
maybe a spark, right?
Barely a spark. And, but it was still there. And, the first property that we bought coming back into it, I was like, I know there's opportunity. Like I know the principles of buy low, sell high, right? You want to buy when everyone else is scared. Like I get that. It's really hard to understand that and actually take action when it's like your blood out in the streets, right? Like it's just, so it took a while for me to really make the mental shift of, what, even though like I'm getting crushed and people are, taking advantage of this opportunity that I'm basically losing everything. Like I need to be one of those people taking advantage of that. I need to be out there buying. It just took me, a couple of years to really get back into that mindset. And so we bought a small multifamily property, and then I bought an office building, and we bought a few other things, and slowly but surely kind of crept back into it, made some really good money on those first couple deals, stabilized them, turned around, sold them. And then I just like, this is it, man. Like we need to do this in a bigger scale. And that's about the point in time. This is like 2012-ish. I got introduced to well, let me back up a little bit. I knew that going back into it, I didn't want to buy residential again. I just didn't, in my mind, I didn't have the time to scale this. And the apartment space is for me, it was a way to build that, empire back up a lot quicker than buying one house at a time. Because for me, I wasn't working a job. Like this is my job. Like I need to make money at it again really fast, and I need to build something that was sustainable. And so the landscape had changed in 2000, since 2008, lending was completely different. Everything was different. The world changed. I mean, it's what happened. So I went on this journey of like talking to everyone that had either made it through the downturn and came out on the other side still, with their head intact, or those that I call them the new investors that kind of got in when things were down and, they're on the ride up. I just really wanted to understand exactly what I was about to get myself into with the multifamily. So I fully understood it. And during that journey, I was introduced by a guy by the name of Randy, by a mutual friend. And at that point, and even today, like I truly believe that your net worth is your network, and you need to be out there talking to whoever, right? You just never know who you're going to run into. You never know who you're going to have lunch with or sit on the airplane next to. You have no idea. And so I'm always talking to everyone I can. I had a lunch with this guy named Randy, who was in the mobile home park space. I had no interest in his business whatsoever. I was just going to meet with him because he was recommended by a friend, and this guy had been in the banking world for a long time, and I might be able to pick up something and learn something from him. And I had that 2-hour lunch with Randy, and he spoke about mobile home parks the entire lunch, and basically told me how much better they were than multifamily, and gave me many different reasons, facts supporting his reasoning behind that. And I listened, and I left that meeting basically saying, I'm going to take the next year and I'm going to learn everything I can about this space, and I'm going to buy a mobile home park, and I'm either going to prove or disprove what Randy just told me here at lunch. And bought that first one. It was a highly distressed property. We still own it today. And bought another one after that, bought another one. So like the first one worked, second one worked, third one worked. And now we've got parks in 13 different states. And
wow. So how many parks do you have?
Yeah. So we just, we're at 20 right now. Yeah, 20.
And what's your average amount of trailers per park?
Yeah, I guess the average across the board is probably right about 100. Yeah,
okay.
some higher, some lower. I think we're just over 2,000 pads at this point.
So when you own the park, do you also own the trailers?
Sometimes. That's not how this business was originally built back in the day, and that's not how most of these communities were built or established. But what happens over time is, people might pass away, their heirs don't want their mobile home, or people need to get up and leave and transfer jobs, go somewhere else. They can't afford to move their mobile home. Things like that occur to where we, either the park owner we bought it from, or we end up acquiring units. And so I think we own about 240 trailers, give or take, throughout the various communities.
Okay.
We don't like that side of the business. I don't like to be in the rental business because then you're dealing with roofs and you're dealing with ACs and plumbing and all that. I'd rather just rent them the lot and let them take care of all the rest. And so whenever we have,
essentially your model is buying the land.
That's it. We're buying a parking lot.
You're leasing the land space to the
That's it.
to the one who owns the trailer.
Yeah, our requirement or responsibility is of owning the park itself is essentially maintaining the infrastructure. So the water and sewer lines, the roads, the common areas, if it's got like street lights and things like that. So like we're basically maintaining infrastructure. And if a pipe breaks in someone's unit, or their roof leaks, or their heat goes out, they're dealing with it. As long as we're providing the utility to their unit, that's their problem. And so whenever we acquire trailers, so when we own the trailers, our goal is to not own them as fast as possible. And so a lot of times we'll sell them on very attractive terms, owner finance terms. We'll take a loss on them even. I know that once someone owns that unit, this is the beautiful thing about our space. We've had some residents that have lived in our communities for over 35 years. It's crazy. It's just like a stick-built home. Once they live there, the chance of them leaving, a lot of people stay a long time. And so I know that once they own that home free and clear and they're just paying the lot rent, the chances of them leaving or even defaulting or anything happening is very, very minimal. And so if we got a trailer that's worth $15,000, someone comes to me and they got $10,000 in hand, and I know that they got a good job, they're going to be stable, they're going to be a good resident, good addition to the community, I'll lose $5,000 because I'm going to gain a resident that's going to be there for a very long time. Mm-hmm. They're not going to move that trailer because it's really expensive to move these mobile homes. So yeah, our goal is to not own the trailers themselves, but just the land. Got it.
So what does that look like? I mean, so you buy up a mobile park, right? And then what do the returns look like? I mean, what are you leasing the lots for? I'm sure it varies, right? Based on.
Yeah, that's a little bit of a loaded question, but
right. So answer the best you can.
Yeah. Because we have certain target returns that we look to hit, and there's a lot of opportunities we pass up on that someone else might view as an opportunity because they don't need as aggressive of a return as we might.
Sure.
And so like we're looking to achieve, 15 to 20% cash on cash returns between month 12 to 24. So we assume that we're going to buy something that's not fully stabilized. We buy in different, states of distress. That first year is going to be getting it stabilized. And so month 12 to 24 is what we kind of view as like the real first operational year. We want to be able to hit a levered 15 to 20% cash on cash return annually from that point moving forward.
So that's kind of our goal.
Meaning that we're putting debt. Yeah, we're putting debt on them. Most of the time, the debt we put in place is typically between 65 and 75% loan to value. I think our think our leverage point across our entire portfolio right now is like 67 or 68%. So we don't take high leverage. We take very minimal leverage, and we're looking to achieve, 15 to 20% or higher cash on cash returns. And we have many parks that blow that out of the water. I mean, we've had parks that have provided with normal leverage points, 30, 40, 50% cash on cash returns. That's not the norm. So, I don't want to make people think that you go out and buy a mobile home park, you're going to get 50% annualized cash on cash return. But it's just like with single family. I mean, you just got to buy it right. I mean, there's lots of opportunities out there still. And if you dig deep enough, you should find one.
Without doing the math and pulling out my calculator, if someone were to come in and just buy pure cash, no leverage, were they getting 4 or 5%?
No, probably closer to like 8, 9, or 10%, something like that.
So when you have 8, 9, 10 and you leverage it, that's how you're getting to the 15 to 20 mark?
That's right. Yep.
Okay. So in my mind, I was thinking like it would triple the return. I guess it depends on how much percentage wise you lever too.
Yep, exactly. And like I said, our leverage point's fairly low. I mean, we like to be conservative, especially the second time around. I like to make sure that I'm even more conservative than I was before. Sure. But we're buying for cash flow. So these aren't speculative plays. We're not buying on upside. We're not buying pro forma. We're buying like what's happening there today. And then what kind of improvements can we make to, I hate using the word 10X. I think that's overplayed, but what can we do to basically,
I still go with it.
Times. Yeah. Damn Grant Cardone, right?
Yeah, he still permeates throughout my language, So what are the unique benefits that, are with mobile home parks that maybe aren't there in your opinion with the other commercial asset classes?
Yeah, there's a number of them. I mean, the one big one that stuck out to me that Randy, had kind of first brought up during our conversation is mobile home parks are the only asset class in all of real estate to have a diminishing supply, meaning that there are more mobile home communities that get shut down, torn down, redeveloped for higher and better use each and every year than that actually come online brand new built, right? And so the number is slowly dwindling. That does not exist in any other space. And so that creates a massive barrier to entry. And part of that barrier to entry is that mobile home parks just have a negative stigma. They just do. And it's due to bad operators. It's due to a litany of things. But with that negative stigma comes the fact that municipalities do not like these mobile home communities, especially when they're in their own backyard. And so the chances of getting approval for a new mobile home park is slim to none. Well, it's nearly impople.
Just because of the stigma.
That part stigma, part is, not my backyard. So, even if it was going to be a nicer community, would you want someone building a mobile home community next to your subdivision? Right. And so that's part of it. And then the other part is the amount of land area that a mobile home park takes up, from a density standpoint and from a tax standpoint, it is not in the highest and best use of that land for a municipality. Like from a taxing perspective, like they're going to get a much higher tax bracket or tax basis if they let a multifamily property be built. Like, where we have 100 mobile home lots, you could probably build a 500 unit apartment complex. So it's not really, there's not really incentives for them to approve this type of housing. Although we are in high demand for affordable housing, which is kind of, the debate that's out there in our industry is like, every city throughout the U.S. has a massive demand for affordable housing, and it's ever growing. No one's doing anything to meet that demand. Mobile home parks, literally, these things they're built in controlled environments inside factories. Today they have very similar finishes to stick-built homes, some very high end actually, and then they got builder grade. You got a little bit of everything, but they can literally be made in like a week and a half. It's crazy.
Yeah.
And literally they can go from nothing to being lived in with a certificate of occupancy in less than a month.
So in talking about and that's a great point, rental prices throughout the US from what I've seen, I mean, they've gone up significantly to where, it's really tough for a lower wage earner to get a decent place to stay at an affordable price. Right. So, do you see that this is going to be kind of like an ongoing issue for over the next decade that we need to, we really need to address as a,
absolutely
business leaders, as a country? And then what do we do about it, right?
Yeah, I mean, we're not giving enough incentives to developers to go build, subsidized type housing, and that's why everyone's building market rate apartments. Everything that you see coming out of the ground, they're market rate apartments. And I mean, there's a ton of growth and build happening throughout the U.S., but it's not meeting the demographic that really needs it the most. And so it is a problem. It's a growing problem. Like, we're not even scratching at it right now, barely. And it's unfortunate, so that's one of the things I love about our space, because you could take any one of our mobile home parks in any state that we're in. I don't care what part of the country, I don't care what city it's in. And the mobile home parks we own, they're not trailer parks. I mean, these things are not, they're probably equivalent. Most of the ones we own are probably equivalent to any normal C+ or B+ grade apartment complex. And we have a few that are like A+ grade. I mean, like, they're really nice.
Sure.
Pick any one of those. And within our mobile home community, like, our lot rent on average across the board, some higher, some lower, but the average is about $300 a month. There is no cheaper place in any one of those given cities where we own communities, or anywhere across the country, that you can live, especially a family can live, in a clean, safe, and quiet environment near good schools and good resources for $300 a month. It just doesn't exist.
Sure.
And so there's nowhere cheaper to go. And so that's one of the big benefits of this niche, is that I've only ever had, if they own the home, I'll preface it that way. If they own the mobile home and they're renting the lot from us, which is the majority, we've only ever had one eviction take place throughout the nearly 7 years that we've owned communities. Because what happens is, if they own the home, number one, they have a lot to lose. If they don't pay the $300 lot rent, they have a lot to lose. And number two is, anyone can figure out how to make $300 in a given month. You can go buy a case of water from Walgreens for $3 and go on the corner and sell them for $1, and make $20 when it's all said and done, net profit. And you could figure out how to make that $300 a month lot rent. Sure. That happens. So it's a beautiful thing. I mean, we offer a good product, and it literally is the most affordable product. If they can't afford to live in our community, they're homeless.
Gotcha. So how do you have any challenges managing, this is probably most cases, would you consider it C-class property?
That's it. So, like, we have different
D-class tenants. I mean,
we have different categories. Just like I like to say, where you live, Jack, there's really rough project type neighborhoods that, you wouldn't want to go into at night, probably even during the day. And you got really high end neighborhoods with, multi-million-dollar homes. And then you got like kind of the blue collar neighborhoods, right?
Sure.
Different types of demographics you're serving. Apartments, the same thing. You got really high end new stuff. You got older project type material. And then you got kind of the C and B grade in the middle. Same exists in the mobile home park space. And so, like, really, you attract the resident that ultimately wants to live in your grade of community. So we own more so, it's a 5-star system, that how they grade mobile home parks. And we own anywhere from like 2.5 star to 4-star. So we're in the middle. Our 4-star stuff is mature, mostly senior residents that are on fixed incomes. They pay on time. They don't cause problems. They maintain their yards. They do landscaping. I mean, they keep a nice, clean and quiet presence. And
that's probably your dream tenants right there.
Yeah. Right? Well, sometimes they can be overbearing as far as like their demands, though. So yeah. And then we've got a lot of folks that are just they're kind of on the blue collar category. They want the best for their kids still. They still want to be in good schools. They can't afford a $150,000 stick-built home. But they want a nice roof over their head, one that they can call their own. And they pay their bills on time. And, you just like anything, you get challenging tenants here and there. As long as you got a really good screening process in place, we try to filter those out. But, they come, it's part of the territory of being a landlord. No matter what class you're renting to, those challenges come, and we just try to mitigate them as much as possible.
Yeah, absolutely. So got a couple questions left here. We're about out of time. This has been very insightful. Can investors are you taking on in private investors, private money to syndication type with your deals, or how does it work as far as, if those are interested, want to invest with you?
We do. Yeah, we have a filing under Reg D 506C, and so we have a fund structure where we buy communities, multiple communities underneath one capital raise event. We're on our second fund right now, and we'll be opening a third fund in the latter half of this year. So it's designated for accredited investors only. But if anyone has an interest in that, they can go to our website, our company website, sunrisecapitalinvestors.com, and there they can click on a link that says, I think it says investors, and that will take them to a secure portal where we have our private placement memorandum and investment summary and overview, all available for folks to view. And again, as long as they're accredited, we look for partners, and we've got a number of partners we've been working with for a couple of years now, and
So guys, accredited is you have to have $1 million in net worth or more,
excluding your primary.
Yep. Or 250,000 between a married couple. Is that right?
I think it's 200 as a single and 300,000 as a married couple of income.
I think you're right. Yep.
Yeah.
So, well, anyways, fact check my numbers there on that. If you're not sure if you're an accredited investor or not. So last question we always ask is, what is the one question that maybe we should have asked but didn't think to ask you?
That's a good question. One question you should have asked. A lot of people ask me, when I go through the whole topic of what happened in 2008, like what I would have done differently, and if I could have gone back in time, and and I don't know if I have a great answer, because I feel like I've always been a conservative investor, and I don't think I was over levered. The one thing that I would have done differently, though, is, and this isn't putting down one type of investment over another. It's just more so based on my personality and what I wanted to accomplish. I should have put more emphasis on buying my multifamily properties than the single family, because I fell into this comfort zone. I had this machine going with the single families. Like, I knew it. It was easy. I could do it while asleep at the wheel. And in the multifamily stuff I bought, I kind of bought in partnerships. I wasn't overly involved in the oversight or the operations. And I should have stepped to the other side and focused on that and built I could have literally been 5 times the size than in the same amount of time that I was in the single family stuff. So I guess if I'd give myself some advice, it would have been, get out of your comfort zone quicker. Like, don't get complacent. Don't just keep doing something because it's easy and it's what you know. And I'm not saying that was the reason for my downfall. I mean, the economy had a lot to do with it, and
Sure.
a lot of folks that are way smarter than I ran into the same challenges I did. Yeah. But more so, get out of your comfort zone, and get uncomfortable, learn something new. Always be trying to improve yourself, and surround yourself with others that are striving for the same thing, right? That are looking for bigger and better, that aren't falling into that complacent state. So
sure. Yeah, I mean, so many people would say, well, there were so many signs, why didn't we see it? But then when you're
in hindsight,
hindsight's 20/20 vision.
Yeah.
So, it just seemed like a kind of a life threw you a curveball, but you've certainly rebounded, 10x.
10x.
I'll use it.
There you
10x. You 10x'd it. 10x'd your recovery. So, you already, I think you already gave us your website. You want to give that one more time if anybody's interested in getting a hold of you, and then also your podcast. How do they?
Yeah. So a couple of different things. I host 2 weekly podcasts. One is called Real Estate Investing for Cash Flow. It's a commercial real estate investing show where we essentially interview folks that specialize in a litany of different asset classes, commercial asset classes. So anything from shopping centers to office buildings to self-storage to mobile home parks to marinas, car washes. I mean, the list goes on and on.
Awesome.
And I've been doing that for like 5 years. So we've got lots of episodes up there. And then we've also got a mobile home park investing show, which we do weekly, which is obviously is very niche and focused on the topic that we've been talking here about today, mobile home park investing. So you can, find me there. My website is kevinbupp.com. That's my personal website. You can track me down there. And then if anyone has an interest in learning about the investment opportunity that we offer, our company name is Sunrise Capital Investors, and the company website is sunrisecapitalinvestors.com. So through any one of those different venues, you'll be able to track me down. I'm not too hard to find.
All right. Very good. Plenty of opportunities for our listeners to follow you. So thank you, Kevin, so much for all your wisdom and expertise. And I know I learned a ton, on this show, just being the interviewer. I didn't know really anything about how this model works. So fantastic, and you're doing some great things. So keep doing what you're doing, and you're gonna obviously you're seeing great success and going to continue on that path. So
Yeah.
all right. So hey, listeners, I have a request. If you could be so kind to go to our wherever you go to like get our podcast, give us a 5-star review if you like what we do. Feel like we're giving a lot of value. We're bringing on a lot of different topics and guests on our show. So we'd love to get some 5-star reviews, which would be great for us in terms of boosting us up in the rankings. And so it's definitely like asking you guys all as a favor. And then also if you could give us a review as well, we'd love to get some reviews going on our show, and would much appreciate that. So with that, guys, have a great week. We will be back next week with a new episode, and stay tuned. So everybody, thanks so much for listening. Have a great day.